Good evening, everyone. It really is, for me, an honor and a pleasure to serve as the moderator for tonight's conversation, so the changing landscape of Wall Street. Let me just lay a few ground rules. First, moderator, experts, okay? Just so there's no confusion. So what I'm going to do is I'm going to introduce our two panelists. Then I will kick off the conversation by asking them a couple of questions. After that, and they've had some time to respond, we will open the floor to your questions. So think of some good ones. I am so proud to introduce two of the most valuable assets in the Stillman portfolio. Jim O'Brien, Tony Levisic. These two individuals have had such a profound effect on the Stillman experience that it's hard for me to imagine that everyone in this room does not know them. So consider this just a little refresher. I'll start with Jim. Jim is Senior Managing Partner of Napier Park Global Capital. And stick with me here because Jim's career is a little like a course on mergers and acquisitions, all right? So listen carefully. After earning his finance degree in 1982 from the Stillman School, Jim spent the early part of his career in the fixed income division of Morgan Stanley. In 2005, he co-founded Carlton Hill Global Capital, a specialized asset management firm. When Carlton Hill was acquired by Citi in 2007, Jim became co-CEO of Citi Capital Advisors, Citigroup's alternative investment arm. In February of 2013, Napier Park separated from Citi Capital Advisors, and Jim became the managing partner of this new firm. Jim, as Dr. Esteban said, is a former member of the Seton Hall University Board of Regents and also former member of the Stillman's President's Advisory Council. He and his wife, Judy, have been extraordinarily generous supporters of a number of Stillman initiatives, including our annual Jim and Judy O'Brien Capital Markets Colloquium, our Center for Securities Trading and Analysis, and our undergraduate business newspaper, the Stillman Exchange, which Bill Redmond had some wonderful things to say about earlier this evening. In addition, as you'll hear later, Jim has used his own work experience to give our students the opportunity to apply the lessons that they've learned in the classroom to a real project, or as we like to say at Stillman, to transform concepts into business practice. So please help me welcome first panelist, Jim O'Brien. So you get to come to life. Tony Levisic. Tony joined the faculty in 1992. Since that time, he has taught courses in both economics and finance at the graduate and undergraduate levels. His research interests include portfolio analysis and performance, financial market behavior, corporate governance, and financial education. Tony keeps his teaching and his research current through his work at Covington Associates, where he is actually vice president and portfolio manager, in addition, of course, to his full-time job at Stillman. Tony's gifts are many, but he is really known for his phenomenal teaching and his extraordinary attention to students. In fact, Tony was one of only 5 faculty members across the entire university to be named Teacher of the Year this year, the first time this award has been made at Seton Hall University. So I'll give you an example of the difference between Tony and another Stillman faculty member. So if you ask another Stillman faculty member, did you have Vijar Kohli in class? They'll say, oh, sure, I remember Vijar. He was a great guy, did really well. I think he's out on his own now with his own firm. Tony would say, yes, Vijar Kohli. I had him in the fall semester of 2008. He sat on the left-hand side, 3rd row. That is attention to students. So please help me welcome my colleague, Tony Levisic. And now I'll take my moderator's seat and we will begin. This is the hard part. Okay, so Tony, Jim, how are changes in technology and regulations especially since the financial crisis of 2007-2009, affecting the way that we do business in the financial markets?
So can I just start with I just want a quick thank you?
Oh, absolutely.
So I just wanted to thank you all for being here. It's very nice of you to be here. I don't generally like speaking in public, and I don't know who I'm more angry with, the Seton Hall people that keep asking me, or myself that keep agreeing to do it. But I wanted to thank President Esteban and his beautiful wife Jo for their commitment and sacrifice and work for Seton Hall University. He's just been an amazing administrator and president of this university. And to Dean Strausser for the work that she's done at the Stillman School. Really has taken things to another level at Stillman, and it just goes from strength to strength. So I'm very proud to be a part of that. I just want to acknowledge, and of course my partner in crime, Tony Levisek, without whom I probably wouldn't be as involved in Seton Hall as I am today, and we'll get to that, more of that later on in the presentation. But Tony's approach to the world and concept to practice is, I think, invaluable not only to the students at Seton Hall, but to the people that get involved in the university. And I just want to acknowledge two people in the audience. One is Betsy Hill, who is my partner at Napier Park. Betsy is our Director of Research and a very valuable partner and friend to Seton Hall, and you'll hear more about that later on in the evening. So Betsy is right in the middle there. Thank you. And secondly, my beautiful daughter Megan, who's here tonight, who has seen a fair share of her future inheritance go to Seton Hall over the past 10 years, and has done so willingly, and very happy to have her here supporting us tonight. So thank you, Megan. So shall I take a stab? So I'm going to use my notes a little bit because I'm a little older now. My memory isn't as good as it used to be. So I think the two issues really are technology and regulation. So technology is more of a longer term secular impact on the industry that we've seen kind of evolving over the past 10 plus years and will continue to evolve. And if you think about how technology has evolved, initially technology was kind of deployed as a means of more efficient execution and more transparent execution, starting with foreign exchange markets, then moving to the kind of futures markets, equity markets, where you used to have a lot of people on the floor of an exchange screaming and yelling and running around with pads of paper. You don't see those people anymore. You see computer terminals and people operating terminals. And now finally the fixed income markets are becoming, the bond markets are becoming more technologically focused. And I think the shift in focus that we've seen in technology, and it'll continue to advance in my view, and in a way that I think is favorable for young people coming out of business schools over the course of the next 10 years, is the shift has gone from one of purely kind of improving the efficiency of execution, narrowing bid-offer spreads on equities and bonds and futures and foreign exchange, to kind of an additional kind of benefit and focus on kind of preserving and protecting pools of liquidity in the various markets with a very heavy regulatory focus. And also the regulators now being extremely focused on kind of the safety and soundness of the trading markets. So whether it's a stock exchange or it's foreign exchange portals or it's futures exchanges, or now some of the bond market and derivative market exchanges, making sure that the clearing and custody functions are kind of properly handled and properly capitalized. So reducing the risk of failed transactions and defaulted transactions, and really making the market kind of overall more safe and sound. So I think technology is evolved in that way, which is probably more of a cyclical kind of happening. I think the secular function is more just continuing to deploy and improve technology. And I think the kind of the next gen technology, which you're already seeing in some cases, is kind of artificial intelligence. So you see that in program trading, in equities, you see it in algorithmic trading, in macro markets, things that are purely driven by computer models and kind of artificial intelligence. That will continue to develop, and I think, again, will create great opportunities for young people, the next generation coming out of schools with just higher order mathematical skills, higher order technology skills, and all the dinosaurs like me will be kind of pushed to the side, and the new generation will take over. So I see it as kind of a win-win in a lot of ways. Technology improving liquidity, improving governance, and ultimately improving kind of the rapidity with which you can trade and execute in markets.
I think, just to add to what Jim said, we're also seeing the emergence of some, you could say, highfalutin terms. As you know, Jim, high-frequency trading, dark pools. And I think increasingly we're going to see that companies are becoming more and more and more competitive. Not that they weren't competitive before, but I think everybody's looking for that special edge. And we see that in Flash Boys, for example, in the book written by Michael Lewis. In addition to that, too, I can say on a day-to-day basis, what I see in my own job is a move, of course, and this is part of Graham Dodd, to push for greater, if you will, moves toward fiduciary responsibility. It's not yet there yet, but what we mean by that, for people like myself who are in the investment advisory world, you can see the increasing pressure to make sure that the client comes first and not the firm. And now that sounds natural, but I can tell you too, behind that there's a lot of work, because it's been pressure on us not only to look, Jim, for best execution, but now we have to look for the lowest possible trading fees. So that has moved us in some cases to move from the more expensive and full service platforms at companies such as Bank of America, Merrill Lynch, Morgan Stanley, et cetera. Now we move to more, if you will, discount style platforms. But that means then that we have to take care of all the compliance, we have to take care of all the record keeping, we have to take care of all the problems with clients, where before we would just call people and say, hey, we got this problem here, can you please take care of it, take care of this client for us? Now it's up to us. And a lot of that work, of course, is from a regulatory standpoint, Jim, it's unproductive, but it still has to be done at the beginning of the day and the end of the day.
Yeah. And I
Also,
think,
I was going to say something else too. What I've also noticed is I believe the investment banking world, and some of you who are involved in this area, I believe already know this, it's getting squeezed. It's becoming more and more of a fee-based business. The days where you might see, let's say, blowout earnings from some of the big bulge bracket firms, Morgan Stanley, Goldman Sachs, may be history, at least in our lifetimes. In fact, it's a quick story about fee-based business. This happened in South Orange with a bank that I've banked with for more than 20 years. And I've got some money there. I started noticing on my monthly statements, they were deducting a fee. What's this fee all about? Because all I ever do is make deposits with this bank. It was deducting a fee because it says I was not using the bank machine. Well, I have automatic deposit. Why should I use the bank machine? So I met with the branch manager and I said, you are charging me for depositing money. We are? I said, yes, look at this, because I simply don't withdraw money, I simply give you money. I said, we'll take care of that. But that's where I think things are going. It's to find every penny that the banking industry can find, to raise earnings and ultimately, as you know, Jim, satisfy the shareholders.
No kidding. So the second point of the question is legislation and regulation. And it's in particular post the crisis in 2008-9, the regulation and legislative environment really impacts the fixed income market, so lending, trading of bonds, derivative markets, et cetera. And it really impacts in there are kind of three ways. The first way, which is important, is the restriction on proprietary trading. So banks, before the crisis, were very big risk takers on their own balance sheet. And in some ways it was and I'll talk in a minute about, in some ways it was a very good thing, and in some ways it became a very bad thing. And there was a great quote, and I wish I could remember who it was from, but the quote was, Wall Street excels at taking a very good idea and then doing it to such excess that it becomes a very bad idea. And I think that kind of exemplifies what happened in the crisis. So proprietary trading became a no-no at banks, and it really put a meaningful damper on liquidity and kind of turnover, particularly in the fixed income markets, because banks, if you think about the history of banks and the function of banks, it's really providing credit, right? So banks are the big providers of credit. So they've been restricted in terms of the types of risks they can take in their balance sheet. Secondly, to the extent they still take risk, lending money, securitizing mortgages to sell mortgage bonds, trading in credit derivatives to hedge exposures, et cetera, the capital charges that banks accrue are much higher. So the banks are required to hold a certain amount of capital, or think of it as cash, in the bank to kind of absorb the impact of downtrends in the market. Well, that amount of cash they have to hold has gone up dramatically since the crisis. So they have more restrictions on the risk they can take, and then higher capital charges for the risks that they do take. And then finally, to Tony's point, the higher standards for compliance and reporting mean that banks are spending a lot more money and a lot more time and a lot more of their focus kind of explaining and reporting what they do to regulators, as opposed to folks facing their clients and making sure they're solving client problems and engaging in things like lending and credit provision for companies. So when you add that up, I mean, from a plus side, the whole regulatory impulse was to make banks safer. So the positive is banks have become a lot more safer. The likelihood of a bank going bankrupt and having to be bailed out has gone down to a very, very de minimis level. And that's kind of that was the whole idea, so that's a good thing. I think the negative is, from the bank's perspective, the combination of the higher charges for compliance, the restrictions on how much revenue they can generate from their proprietary risk-taking, and their capital charges having gone up, so there's more money sitting in the bank that's not being productively deployed, means that their return on equity, their earnings, and their stock prices are lower. And ultimately, what's really happening is the regulators want the banks to be more like utilities. They want them to have a more regulated allocation of capital, return on capital, which, depending on your perspective, may not be a bad thing. But it has an unintended consequence, which we see in our business, which is really fixed income credit, in that banks historically were a big buffer. They were a big kind of loss absorption buffer. When markets disrupted, prices dropped, banks, because they're credit focused, they were big risk takers in markets when liquidity tended to get difficult. So they provided this kind of cushion for volatility in prices, and that cushion is gone. So the risk of what we call liquidity interruption, where markets trade and all of a sudden they don't trade and prices go down dramatically in a very rapid fashion. We've seen a small example of that in the last month in high yield bond markets, investment grade bond markets, mortgage markets, et cetera. That buffer is gone. So the markets have become more volatile, and that risk of liquidity interruption has gone up. And this is the piece of it that I still don't think the regulators fully understand and appreciate, and haven't really thought about how to address it. Because what's happening now is a bank in a downdraft, in a difficult market, sees an interesting opportunity. Instead of getting together, putting their heads together, coming up with a price, positioning the risk, they're calling people like me and saying, look, we have an interesting opportunity, you guys should do this. And so you're taking what used to be risk-taking in a very highly regulated environment and putting it into a much less regulated environment, which, depending on your perspective, and for me it's a great thing, but depending on your perspective, it may not be such a good thing. So that's kind of the unintended consequence. And ultimately, longer term, then my partner, John Dorfman, says, that what they've done is they've created a much safer car, but a much bumpier ride, is what the regulators have done, which I think is a good way of analogizing it. And ultimately, in a more difficult economy, it's going to restrict the bank's ability to provide credit to individuals and companies, and et cetera. So it's kind of a mixed, I'd say it's a mixed blessing, but certainly with the right focus and the right initiative.
I was going to add to what Jim just, inside information in this respect, but you were at Citi, of course, in alternative investments. And then, of course, with the new regulations and the tier capital requirements, you're no longer at Citi. You had to be, in manner of speaking, spun off. Some would say, in some circles, thrown to the streets to fend for himself.
I like that version.
Yes, there you go.
That was much better than Bloomberg's version.
Yeah.
Okay, so let's move on, and let me ask the two of you to comment on the level of interest rates.
If anyone's been following interest rate movements, you probably noticed, even today, just keep it light, of course, the 10-year Treasury note, 2.2%. The 30-year Treasury bond, 2.95%. This has been hellish for the saver, okay, who's looking for a nice return that's virtually guaranteed. It's been great, though, for issuers. With lower interest rates, okay, you can call your bonds in that were issued at 4, 5, 6, 7%, have the interest rates cut in half, and bingo, your balance sheet looks mighty good. But to put some of this in perspective as well, given that currently we have what seems to be a slowdown in the global economy, I believe at this time, just given this relationship between short-term interest rates and long-term interest rates, I think they're here to stay for a while. And so as a result, now this is not investment advice, ladies and gentlemen, but I'm still long equities, and I will continue to stay long equities, going back to what Jim mentioned before with some of the recent volatility. And this may segue into a discussion later on that you and I will have, Jim, about opportunity, where some people see scarcity, some of us might see abundance.
Yeah.
Your comments?
So the environment today, to kind of analogize it to a previous period, it feels a lot like, and I'm paraphrasing, again, my partner, who's really the investor in our firm. I'm not the investor, I'm the people guy. It feels a lot like the mid-90s. So you have a very similar environment where you have low interest rates, you have a strong dollar, which is leading to weaker commodities prices. It's leading to weaker emerging market foreign exchange valuations, particularly emerging market countries that are resource exporters. You've seen a dramatic decline in energy prices, a decline in some foodstuffs like wheat in particular, some metals. So natural resource-oriented emerging market economies are struggling and our currencies are struggling as a result. So you have an environment of kind of low rates, declining commodity prices, stronger dollar, weak emerging market FX. And in the 90s, what that ended up manifesting itself in was a pretty meaningful rally in equities. So you had from 94 to 98, you had an equity market that almost tripled. And then you had the long-term capital management crisis on the back of the Asian default cycle and the Russian default. Equities corrected by 50%. And that set up another rally from kind of, that was kind of a 98 to 2000 or 98 to 2000, and then equities kind of doubled and then corrected down at the end of 2008, another 55%, and now they've kind of tripled since that period of time. But we're not really negative on equities. We actually think, given the level of where we are in the economic recovery, which has been very slow but seems to be slowly gathering momentum, continued low interest rates, which is being forced by the Federal Reserve policy, which I'll talk about in a minute, high levels of cash on corporate balance sheets in very, very good shape right now, a mergers and acquisitions cycle that's really kicking into high gear, with a very high percentage of it being more strategic M&A, not kind of private equity firms and hedge funds buying companies with a lot of leverage, but companies buying each other and buying each other's divisions. It's pretty hard to imagine the market having a significant sell-off. Now, we've seen a lot of volatility in the last couple of weeks, but on balance, the market hasn't done much. It's just gone up 200 and down 200, up 200 down. It's gut-wrenching, but it really hasn't done much. We actually think it's hard to imagine an environment where corporations start to experience balance sheet stress and equities sell off when you have that kind of mix of fundamentals underlying the market. So we actually feel pretty good about, we're not equity traders, but we feel pretty good about equity market valuation levels right now. And that kind of corollary to kind of the mid-90s we think is pretty powerful. When you think about how we got here, a combination of a really horrible collapse in 2008, 2009, very, very slow recovery with a lot of moving parts and the interconnectedness of global economies, a lot of geopolitical stress in many different parts of the world. We happen to be in 2014 in the middle of a global election cycle, which is creating a lot of political, kind of populist political pressures all around the world, which is a difficult market to navigate as well. The only functioning kind of organization in Washington right now is the Federal Reserve. You know, the rest of Washington is kind of hamstrung by politics, and nobody wants to make a decision, and nobody's willing to come to the table and negotiate, and it's just a horrible environment politically. But the Fed has a fair amount of independence, and given the lack of initiative on the fiscal front and a lack of initiative on the economic kind of policy front with respect to how you would get the economy kind of back on track, the Fed has been the one making decisions saying we're going to keep rates at zero for a long time. And in our view, you know, the Fed had the benefit as they wound down this QE, this buying of bonds onto their balance sheet to kind of stimulate demand in the long end of the bond markets. They benefited from all the geopolitical stress and the kind of flight to quality to the dollar and to the U.S. Treasury market. So the market didn't really react to them kind of gradually cutting down the number of bonds they're buying every month. We think they made a mistake in the last minutes of their last policy meeting in not making it clear that rates are going up sometime soon. Call soon 12 to 18 months. They're not going to stay at zero forever because the economy is beginning to grow. Wages are beginning to grow, particularly in industrial places like Texas as an example. You're beginning to see wage pressure. The offset to that is the participation rate in the job market is down. A lot of people have stopped looking for a job, or they've hit retirement age and aren't working any longer. But there's definitely signs that households are spending again, job creation's improving, wages are beginning to rise. And there's no question that at some point the Fed will start to push rates up again. It's just a question of when. And not making it more clear that that's still an imminent risk, they kind of let the market jump right back in with both feet. And as Tony mentioned, you've got bond yields down at almost historic lows again, and equities chopping around like crazy, and the dollar continuing to be relatively strong. It's not created a very healthy market environment for investors or savers, but on balance, we think the Fed's actually done a pretty good job.
Yeah, I would agree with that as well. In fact, just a couple more points. You typically don't read about this, but be careful of statements by the financial media. Remember, the financial media are out to make news, not necessarily report news. With all due respect to the financial media, anyone in here, this notion that the Fed is printing money is incorrect. It's more of what we would say is an asset swap. So be careful of those kinds of statements, first of all. And a couple of other points, too, concerning the Federal Reserve System. I think the Federal Reserve System, of course, since it is a quasi-private organization, is out to help the commercial banking industry. And so by keeping short-term rates of interest very low, you have a net interest spread, okay, between what banks can borrow at versus, in this case, what they can lend at. And that's helped the banking community quite a bit out of that financial crisis that Jim has referred to. Also, too, this is helping the U.S. Department of Treasury, because they can now not only float Treasury bills, Treasury notes, and Treasury bonds at record low interest rates, but when people, in this case, will be receiving their interest back in future years, they're going to be receiving it back, as Jim knows very well, in cheaper dollars. After taxes and after inflation, it's not going to be a good deal for investors. It may seem safe for now, but it's not going to be safe for the longer term.
No doubt.
All right, so let's turn, talking about risk, let's turn to a question about young people and their preferences. Why are young people, and for the purposes of this question, we might have a different definition. Young to me would be anyone my age or younger, but we might consider younger. So why are young people? Good, we're on board with that.
Jim, you're a father. You have your daughter here. Maybe you can gain some insight that I don't have. Please begin.
So why are they so risk averse, and should they be when it comes to investing?
So it's interesting. It was a great, and I don't remember if it was Joyce or Tony's idea, this question, but I think it's a good one. We have a series every month or every other month. We have somebody come in and talk to the young people in our company, and we have different topics. So somebody will come in and talk about bank regulation, really interesting stuff like bank regulation, accounting, And one of the gentlemen who came in is an advisor to our firm. He's in his late 70s. He's a legendary private equity investor. He came in and talked to our young people about investing, personal investing. And he asked the question, there were probably 15 people in the room, and they were all, by anyone's definition, young. They were all in their kind of 20s. How many of you invest in stocks? Not a single hand went up. And how many of you all work at Citigroup at the time. How many of you know where Citi stock trades today? I think 2 of the 16 knew where Citigroup stock traded. Had a clue about what the market capitalization of Citi was. How much is the total stock capitalization of the company? And he went ballistic. And he started, reading them the riot act about how you guys are nuts. This guy, pointing to me, I expect him to spend all of his time running your company. I expect you guys to spend a fair amount of your time thinking about how to invest your money in stocks, because your risk aversion is acquired by, the past 10 years has been a pretty horrible time to be a stock investor. So if you invested in stocks, you watched, if you were lucky, half of your wealth evaporate in the downdraft in 2008 and 2009. And then by that point, you were so broke, you didn't have the opportunity to invest and take advantage of the huge updraft since then. And it's just been a horrible time. And I think the psychology of people in their 20s is one of stocks are really, really risky. So what do you do with your money? Well, part of the problem, if you dial back a little bit further, is these kids are coming out of school now with a debt burden that's much higher than their starting salaries would support. So the math of kind of what's it costing to go to college and how much am I coming out of college with in debt, and how much am I getting paid in an environment where salaries have really been crushed and are now coming back, that math is really out of whack right now. So even if I wanted to invest in stocks, it's not easy to do so because I don't have that disposable income. And he had a really interesting, he said, look, first thing you have to do is you have to pay yourself first. So when you think about how you organize your finances and you get paid every month or every other week, whatever it is, some portion of that you have to set aside and save it in some manner. Doesn't matter what it is. And he's recommending strongly you do it in equities because you're a young person. Over time, if you're not completely ignorant of what's going on around you and you pay attention, you will do well in equities over a long period of time. And you should have some portion of your equity exposure that's indexed broadly, so it's invested in the S&P 500 or the Dow or the NASDAQ or whatever you want to invest it in, but index it so it doesn't take too much work. And then some portion of your money should be more of a, call it a trading strategy. And what he recommended is, and what he does personally, is every year he looks at the bottom 25 stocks of the S&P 500. And he said, if you think about the stocks that have the biggest upside in any given year, other than IPOs of technology companies and biotech companies, are stocks that got crushed for some reason the previous year. And the trick is, of those 25 companies, probably half or more of them are going to be gone in 2 years. And half of the remaining half are going to kind of bounce along the bottom. And the other half are going to do really well. And a handful of them are going to be moonshots. So that's where you really do your homework. So you pick a handful of those companies and you analyze them to death and you come up with an informed opinion and you make investments and you see where you're right and where you're wrong. And don't risk too much of your money, but you'll find that over time that strategy will really work. And we really try to encourage the young people that work for us to think that way. You have to think about investing and paying yourself first and not being afraid to take some risk, because it is scary to take risk when you don't have that much money to risk in the first place. But if you don't do it, you end up in your 40s with a family and a mortgage and college tuitions you're trying to fund and everything else, and you haven't really thought about your long-term saving, and suddenly, how am I going to retire? And I think that's a trap that a lot of people are finding themselves in today. So it's kind of an important cultural message that we get across, I think, to young people today. But I understand why they're afraid.
Yeah, I would add that everything in life, and I do mean everything, boils down to 3 words: return to risk. Return to risk. In other words, as all of us know, the only way to get anything out of life is to get out of bed every morning. Because even if you want to play the New York and New Jersey lotto, you got to get out of bed and go buy a ticket. But I'm afraid that my return to risk phrase may be dying, at least with the past generation, or the generation behind us, Jim, because it seems to be not so much risk, but loss aversion, the aversion to loss. And that seems to be critical right now. And it may very well be, Jim, because of the high educational loans. I'm not sure. But I talk to young people who say, my first concern is to get a job and to pay off the debt that I have. It doesn't matter, Seton Hall, whatever educational institution it is. And so the long-term perspective from stocks just isn't there. And maybe, given what's happened in the markets the last 15 years, it's understandable. You know, we had such a boom time in the 1990s where it seemed that nobody could be wrong. And then, of course, I ran out some numbers on this, through December of 2009, if you had thrown some money in an index fund, as Jim has just recommended, and I would have recommended the same thing, you would have been down 1% a year. In other words, 10 years of effort for nothing. And you had 2 periods there in 2002 where stocks were down 22%, and then, of course, in 2008, 36%. And as Jim has, I think, nailed it, yeah, that's scary. But then again, you know, there's a song, I think, written by Jerome Kern, pick yourself up, dust yourself off, start all over again. And so one has to say, okay, do I see some opportunity here? As all of us know, in the Seton Hall tradition, you don't score any points by sitting on the bench and wishing. You know, you got to get out there and you got to do it. And that can be tough, but it's the only way in the end that one is going to be able to move forward, as tough as that might be. So, in fact, we have hired 2 people at this firm that I work with, Covington and Associates, both graduates of Seton Hall. One is 31, one is 28, and you see that same hesitancy, the same hesitancy to want to put some money in stocks because of the fluctuation, the chance for loss. But, as you know, Derek Jeter, he struck out a lot, didn't he? Did that keep him, in this case, from coming from the dugout back to home plate and swinging away again? It did not. And that's what you have to do. And that's what I try to at least tell young people, you know, you have to stick to it. You have to get it going, because it's the only way in the end they're going to be able to get ahead. If we look at the long-term statistics, going back to fixed income, treasury bills, treasury bonds, corporates, municipals, once you subtract away inflation and taxes, the long-term rate of return on those securities is less than 1%. And if you remember anything about the doubling principles in finance, you know, you're not going to get rich that way. So in some way, ignorance may be bliss, but I've not found a way, or anyone who's told me that it's very profitable So you're going to have to, in this case, I think, ultimately invest at least a certain portion in stocks, because after taxes and inflation, over time for the past 80 years, stocks have yielded about 5%. So in terms of return to risk, it's the better deal.
Any rebuttal tunes, Jim?
Yeah, I'll do it.
All right, so let's go, continuing on the conversation of young people. Both of you have one foot in academe, one foot in practice community. What do you see as the future of education, particularly business education? And what are you doing about that?
For a long time, I'm sharing with you a threefold vision I've had. One is, of course, is to raise the academic profile of the Department of Finance, the Stillman School of Business, and Seton Hall University. Second is to help drive the educational experience beyond the classroom. I'm not afraid to share, and I think I may be as well, maybe borrowing some words from Jim, we were pretty good at memorizing our way through material in school. But then when you got out, maybe you knew a few terms and words, but could you really help people? Maybe not as well as we would have liked. And so ultimately, by, if you will, bridging that gap from concept to practice, it's all about broadening the market for student careers. Whether it's, Jim, to a nod to you, it's in the finance world, or to Betsy or Nito or Andrew, or Joyce, to you, a nod to the accounting world, or Ping back here, or Joe Guasconi, a nod to the legal world, or if I may even say so, our priests, a nod to religious studies. In fact, as a quick story, about 10 years ago, as I was sharing this notion of concept to practice with a priest, he said, that's pretty important in the professional studies. So I nodded my head and I said, yes. And I said, I remember being at Mass at Seton Hall, okay, and you were preaching from the first letter of James, of one mind, of one mind. And I said, I've been trying to put that into practice ever since. So the point we're trying to make here is it's learning by doing, and an active approach to learning, an active approach to going beyond the classroom. And that's where Jim and I first started with the Center for Securities Trading and Analysis, to get students beyond the classroom, to start showing them a little bit more about how they might be able to understand about financial markets. In fact, from there, that led to the germ that started the Stillman Exchange. And just to let you know, the Stillman Exchange was not begun by any person in the Stillman School of Business. The idea came from a student who was an undergraduate in political science and was minoring in chemistry. So in terms of concept to practice, you can see in turn what we might be able to do a better job of preparing students for that next leg up. Because ultimately, I think Jim and I share this vision about being able to pass a torch on to young people that's burning more brightly than the torch passed on to us. Yes, it's a lot of work, but in the end, it's being able to get them more prepared to take the world to the next level. Jim?
Yeah, I think the most important concept, and Tony's whole approach to finance education, which is this concept to practice approach, was what really got me hooked when we were first talking about the trading room, the Center for Securities Analysis. I had no interest in it if it was just going to be a vanity thing for the handful of kids that had an innate interest in markets. It had to be core to what we were doing in finance, and that was his plan from day one. And when he laid out the plan for me, I was so impressed with it. It was going to become an integral part of the curriculum that we really committed to it and helped get it off the ground. And the subsequent things that we've done since then have all been part of this whole idea of not having kids come out of the business school with just a very theoretical knowledge, but more of a practical, hands-on, I know how to use a Bloomberg, I know how to message, I know how to analyze a balance sheet, I know how to look things up, I know how to communicate in that environment, which I think is a really important part of it. The challenge with that approach is that it requires constant care and watering, and it's an evolutionary process. It constantly evolves. So I mentioned earlier, with the evolution of technologies and the evolution of market structures, it requires that we continually update the way that we teach kids and the way that we approach kids, students, the way that we teach students, the way we approach the education in finance, so that they're constantly in a position where they're coming out with a practical kind of a practical sense of what the market is really like. It makes them better interviewers, it makes them better employees, and hopefully over time better alumni and givers to Seton Hall. So I think that's an important piece of what Tony's done. When we started Carlton Hill, Betsy Hill, who I mentioned earlier, is a University of Wisconsin graduate, and she runs a program at Wisconsin where she basically goes up there and does these, call them seminars, for the students, where she really teaches them balance sheet analysis, kind of credit analysis, what we do, as opposed to analyzing a company from the perspective of an equity investor, analyzing the company from the perspective of a debt investor in that company. And very, very successful program. And she was going up to do the program and showed me her pitch book, call it, that she was using, the flip deck. And I was so impressed with it that I called Tony and I introduced the two of them. And she began doing that presentation or that program at Carlton Hill and at City and now at Napier Park. And what she does now, and has done for the past few years, is we have a group of students actually come into our office for the day, and they get a kind of a thorough kind of overview of kind of balance sheet analysis, and they get assigned a credit project, and they break up into teams, and each team is assigned a company. And Betsy and Joe Ridgie, who's not here tonight, but is another Seton Hall grad who works for Betsy in the credit research group, they kind of manage the process, and the teams go back to Seton Hall. They do their research independently. They have access to Betsy and Joe and the other members of the research team if they have questions, they need help getting over rough patches. And then they actually come back to the office and they present their research and basically make a recommendation on the company that they've been assigned, and then Betsy kind of scales and effectively grades them and selects a winner who's done the best job. And it's been a fantastic partnership because it really gives these kids a sense, or students, again, sorry, they seem like kids to me because they're so young, most of them aren't shaving yet or anything. It gives them a real, it gets them into a workplace, and I think it's always important to come into a workplace and understand what happens in a workplace and be introduced to people that are senior and that manage businesses and that make risk decisions and make investment commitments on the behalf of our investors. That's important. And it's also important to develop connections. And one of the things that I tell them when I give them the kind of overview speech is you're going to meet people today and when you come back here and over the telephone, and shame on you if you don't network with those people over the next however many years you're left at school, 1 year, 2 years, when you get out of school. If you don't network and stay in touch with Betsy and Joe and myself and the other people that you're going to meet, that's your fault. Part of your job is to learn how to network and learn how to engage people and get involved. And in particular, they see a very senior woman who's incredibly capable and incredibly well known in the business. I think for the female students in our finance population, that's an important thing as well, because hopefully that attracts more of them to Wall Street, which I think has a history and a reputation of being more of a male-dominant culture. I think it's important they meet people like Betsy. So that's been a really important part of what we've tried to do with Seton Hall. And as markets continue to evolve and change, hopefully we'll continue to evolve and change with it.
To add to what Jim just mentioned, I'm thinking too that we did something 2 years ago that was unprecedented at Seton Hall. It, in this case, involved bridging that gap again between, in this case, the Stillman School of Business and the College of Arts and Sciences. We started a program in mathematical finance. And Jim, you remember, of course, you said, Tony, the students are good, but they need more math. They need more math. And many of the students in that program, unofficially right now, I think there are 19 students. I think 12 in this case are women. And so if we can continue.
One is at Wharton.
Yes, one is at Wharton right now, too. As long as we can continue, I think, that kind of program, then we can not just, if you will, serve the finance community better, but I think we also are expanding opportunities for the students to think beyond the traditional silo approaches. And because I think really, in many respects, the future of education lies not only in bridging the gap across these silos, but once again, to go from concept to practice, It's going to require a lot of work, but I think that's how we can advance, I think, society in the way we're currently doing things. And as you know, Joyce, too, as dean, we were able to take the trading room into some other ventures as well. We have, of course, the Market Research Center, where I think students over the past year, they were involved in more than 24 consulting projects. We have the Entrepreneurial Center. We have the Sport Polling Center. So these give students opportunities to take their communication skills, to take their critical thinking skills, to take their change management skills and put them into practice so they will be better trained, better prepared for that next step in life.
I think the last area that we need to focus on more, because I see it a lot with young people coming out of university and interviewing, is their relationship building and selling skills. I think there's not enough focus on formally educating students in how to develop and maintain relationships and how to present themselves and how to present an idea. So if you're lucky enough, like I was as a kid, to work in a kind of a selling retail environment when I was going to high school and college, you kind of learn it by doing. We don't really teach it to the level that I think we need to, and that's an area that I think a differentiator that could be really important, and particularly in an environment where social media has become such an important part of young people's lives. And I think the transition of social media from being social to being professional is a tough one. There are lots of, I've heard Pat Lyons say, you know, your social media presence is your digital tattoo. It never goes away. So anything you do in social media, be it good or be it really stupid, is kind of out there forever. So you have to be really thoughtful about what you put out there in social media. And I think that transition from, and my daughter makes fun of me all the time about my Facebooking, which is, now I found it's for old people. No kids do Facebook anymore. But your transition from a social aspect networking to a professional networking in social media is an important one that needs to be thought out and managed carefully. And then your ability to present yourself, to be able to make yourself interesting, make good first impressions, understand, be a good listener, understand what people are saying and why they're saying it, and be able to kind of engage. And then following up, you know, emailing people, sending them things that you think they might be interested in. There's a bit of an art to it. And teaching that, I think, is important because it doesn't come naturally to most people. You know, some people are incredibly natural, gregarious socializers. A lot of people aren't. And I think the really smart, really dedicated, focused students coming out of a finance program, if they don't have that kind of aspect of their toolkit, I think it's something that's going to hurt them. So that's an area that I think we need to focus on as well.
I think to your point too, Jim, let me just add, this has been a transition for me. I didn't pick up one of these things to 2008, okay? Some would say since it's a BlackBerry, I'm a grandpa. But that aside, no, it's not turned on. With a couple of hires we've made at Covington and Associates, I had to work with them to say, don't text or send them an email message, call the client. Or let's go out and meet the client face to face. As Jim is saying, in terms of communication skills, there's nothing in the end to substitute for good eye-to-eye contact. That is such a key. That is such a key in communication. And when people are texting this way, it just doesn't have the same ring, does it? It doesn't have the same personal engagement. And I think in turn it becomes more difficult, as Jim was implying, from let's say a marketing standpoint, to close a deal. You got to close a deal with a handshake. It's not going to be closed in this case off a text. Yeah.
Well, speaking of closing the deal, I think we're getting the signal. Do we have time for one question, Terrence, or a couple questions? Okay, so what would you like to know from the audience? Mark, one of my current students.
So I'm a junior in Seton School, and I'm currently involved in the Leadership Studies program. I'm working on a project through April, and part of the project I'm researching different alternative investment trends. So I know that you're involved in alternative investing with Napier Park. Why would you say there's a trend going from, like there's pension funds and sovereign wealth funds? Why are they pulling money out of direct real estate investing and moving towards other forms of alternative investing like hedge funds and private equity?
Yeah, it's a good question. I don't see them pulling it out of real estate. I think real estate, what pension funds really are, you think about how pension funds work. Their liability, what they owe, so they owe money to their pensioners, their liability is very long dated. So most pension funds think in terms of 20 to 30 year cycles. They don't think in short-term cycles. So they're always looking for ways to kind of add that kind of duration of the portfolio. So what we see them concentrating on are things like real estate, equity, not so much real estate debt, hard assets, so buying resources, so energy, minerals and mining, buying real resources, farmland, forest, timber investments. We see them investing in equity, public equity, private equity, which is more strategic in their mind, and where they're really starting to allocate back into or increase their allocation to alternatives is in two ways. One is in their equity investments, because markets have become so dominated by program trading and ETFs, equities have, we've seen a little bit more dispersion in the last 6 months. They become much more highly correlated because they're being traded in baskets constantly by these ETFs and by these program trades. Prices tend to move more in tandem with one another, so the correlations are very high. So they're not getting the same kind of differentiation of return out of their equity portfolios that they were before. And in fixed income, because yields are so low, they're really sitting on very low returning, where their fixed income targets before were kind of 4 to 6%, they're earning 1.5 to 3% now. So they're really getting killed on their fixed income portfolios. So to Tony's earlier point, pension funds want nothing more than for long rates to be back at 10%. That makes their life very, very easy. Most of them have a target return on their portfolios of 8%. So anything close to 8%, that kind of immunizes their liability and they're happy forever. So what we're seeing is a lot of allocation out of equity, long-only equity, and fixed income into alternative fixed income. So if you think about what we do, which is credit investing, corporate bonds and derivatives and structures and mortgages, things like that, distressed debt, what we do is we don't take interest rate risk. So we're really isolating credit as an asset class and a source of return without being exposed to rates going up, down, or sideways. And we do it in such a way that we're trying to achieve returns for big, and our clients are big institutions like sovereign wealth funds, pensions, insurance companies, earning them returns of kind of 6 to 10% on a net basis in their fixed income portfolio. And to them, that's home run. So that's where we've seen a lot of the allocation. There hasn't been as much long-short equity. Managers are losing assets. Fund of funds are losing assets. It's more macro, so interest rates and currencies, credit, and then kind of absolute return relative value, so trading across all asset classes for alternative fund managers. And they're allocating much bigger sizes. So we have investors that are allocating between $150 and $400 million at a clip to things that we do, but allocating at much lower fee levels. So the whole 2 and 20 thing is, unless you're a guy that's been around for 25 years and has a spotless track record, you're not getting 2 and 20 anymore. It's a much lower fee scale, but bigger allocations for longer dated time frames and for more specialized assets like what we do. So we think it's a very healthy trend.
Oh, two minutes. Right here.
On the topic of the changing landscape of Wall Street, there are two things that are kind of linked under fairness, stretching it a little bit to link them. But one relates to the banks that are too big to fail. I don't see that, from what I read recently, I don't think there's been much change. I understand that the reserves have gone up to require 3% from 2%. That's like a 0% down mortgage. And is there anything, am I correct on that? Is there anything being done? And the other aspect of fairness is these, I don't know what they call technically, but these people who can get the information milliseconds in advance, which can be very significant for big-time traders.
Yeah,
and
sure.
screw them over.
Yeah. I think the latter is more problematic than the former. So the latter is really a difficult issue because the exchanges have all encouraged this development of high-frequency trading, program trading, and it is really an arms race to who can build the quicker processor, because these are machines that are they're running algorithms constantly across thousands and thousands of stocks, and they're looking for very tiny price anomalies, and they're putting massive amounts of risk into those tiny little price anomalies and hoping they correct and they take their risk back off. And a lot of that, it's not so much people sitting there getting information like you're calling me and saying, hey, I have a tip, and they're making an investment. It's just that machine picking up that price aberration much more quickly than you or I could do it, right? And that's a really difficult one, right?
I've been told by some technological technology that they're even paying to locate their servers when the center is closer, because that fraction of a second to get that information.
That's exactly right, and shorten the pipe between the exchange server and their server. So they're co-locating in locations all over the place with the exchanges. That's a really tough one, and I think there's some legitimacy to it, but honestly, the price anomalies they're taking advantage of, for the most part, are tiny. They're trying to find very small anomalies and put massive amounts of money, and then by the end of the day, they typically take the risk off. They're not taking long-term views. So on one hand, it provides more liquidity to the market. On the other hand, it does unfairly disadvantage the people that just move slower. And that would be anybody from a big mutual fund manager to you and me. So
And just
That's
so
an
you
issue.
know, high-frequency trading really doesn't become really profitable until the so-called volatility index, or the VIX, really gets up there. It has to get in the high 30s and into the 40s before it really takes off. So right now, we're not at that particular level. But to your point, and what Jim was mentioning, I think the University of Michigan about 6 months ago had to eat some crow, did it not? Wasn't it sending information to some, I think Goldman Sachs and a few other firms on consumer confidence? Just a fraction of a second or so before it would release it to the markets. And it enabled them, of course, these banks to take advantage of that just a little bit faster than any of us. And that's your point about it not being fair. It's true, because the whole notion, they would say in academics of efficient markets is that everything that's worth knowing is known. Is it?
Now, the too big to fail question, I think my own opinion is that most of these banks are too big to manage. Forget about too big to fail. They're just too big. But the too big to fail, I do think that first of all, they're still writing the rules. So we're 7 years on, and the regulators, every month something else comes out. There's another restriction on leverage loans, there's another restriction on repo, there's another restriction on proprietary trading, mortgage securitization, risk retention. So the banks really don't know the playbook yet, and that's part of the problem the banks are having, is they're spending too much time wondering if what they just did is actually compliant or not, and not enough time worrying about whether it was the right thing for the bank, the client, whatever else. But they have become much, much more well capitalized. It sounds like a small amount, but it's literally an order of magnitude, much more well capitalized. So the likelihood that a bank today, a big bank today, small banks are in a different situation. They're much more concentrated in terms of the risks they take. They tend to be much more regionally focused and frankly more real estate focused, which is probably not a bad thing as the cycle's changing. But big banks, the likelihood that a big bank could fail today is incredibly remote in the U.S. and in the Europe to a lesser extent, because they're still getting working leverage down, but leverage is down by 2/3. Capital ratios are probably up by 100% for most of the banks. And the way they're allowed to take risk and the order of magnitude of leverage they're allowed to apply really makes their cushion of safety incredibly solid. And I think that's actually a good thing. I still think they're too big and complicated and hard to manage. So that'll probably change over time as well. But until they finish writing the rule book, who knows? I think the banks are in a tough spot. I'm glad not to be at a bank anymore.
Yeah.
Well, I think probably now would be a good time to formally conclude the program, but I know our experts will be here for a few minutes if there are other questions. But I want to thank everybody for being here tonight. It's been a wonderful experience. I know we have some students here. I'm really happy to see them. But remember, Stillman is always the best investment, right? Thanks, everybody. Have a great night.
Thank you to our panelists. What you see up here is what our students experience in a rich academic environment, and what you also have in a Seton Hall network of caring, successful alumni who give back their time and talent and treasure to our Seton Hall Pirate Network worldwide. The bar is remaining open for about a half hour, so you're welcome to stay and ask any questions you didn't get to ask of our panelists. Take a brochure. We're going to be back at Delmonico's in January for a Pirates on Wall Street event, so make sure you take a look at that and check your calendar. Follow us on Twitter and Facebook. Stay in touch with Seton Hall. Go Pirates!